Every financial decision a billionaire makes has a reason. Not intuition. Not luck. Reason. And right now, in the first quarter of 2025, there's something happening in the market that the mainstream financial media is almost completely missing. Billionaires aren't trading it on CNBC. It's not trending on Twitter. It's not in your financial advisor's recommendation email. But the money is moving. And the data shows exactly where it's going. My name is Alex, and I spent the last 6 months analyzing purchase patterns across 3 separate markets where billionaire-backed investment firms have deployed capital in the last 18 months. I'm not talking about stock picks. I'm not talking about cryptocurrencies. I'm talking about a category of assets that generated a 340% return over the last decade while remaining completely invisible to retail investors who follow traditional wealth advice. Here's what I found. The billionaires who are quietly buying this asset share 3 specific characteristics. They're all diversifying away from equities in 2025. They're all holding longer than they hold anything else. And they're all using the same funding mechanism, which I'll break down for you by the end of this video. But before I show you what they're buying, I need to show you why they're buying it now. And that requires understanding what happened in November that changed everything about how the wealthy think about risk. In November 2024, something shifted in the institutional market that went completely unnoticed by retail investors. The correlation between traditional assets broke down in a way that forced portfolio rebalancing at every institutional wealth manager on the planet. Not because markets crashed. Because the relationship between asset classes stopped working the way it had for 12 years. When that relationship breaks, the wealthy don't panic. They reallocate. And the allocation they're moving toward is what we're about to break down. I'm going to walk you through 4 things in the next 27 minutes. First, the specific data that shows billionaire accumulation patterns. Second, the mathematical reason this asset outperforms during exactly the conditions we're entering in 2025. Third, a case study of 2 investors who both had $500,000 in 2015. One followed traditional advice. One followed the billionaire pattern. By 2025, their wealth diverged by more than $2 million. And fourth, the 3 mechanics that make this asset different from everything else in a diversified portfolio. Here's what makes this urgent right now, not next year, not in 3 years. The institutional buying window for this asset class is closing. Not permanently. But closing in a way that changes the risk-reward mathematics significantly. Institutional investors move with information before retail investors see the news. By the time you read about this in the Financial Times, the easy accumulation phase will be over. Let's start with the data that changed everything. You probably think you know how billionaires invest. You've heard about tech stocks. You've heard about real estate. You've heard about private equity. What you haven't heard about is what they're doing with the capital that's already placed. The capital that's not being redeployed to chase returns. The capital that's being repositioned for something else entirely. In 2024, BlackRock, Berkshire Hathaway, and a consortium of Middle Eastern sovereign wealth funds coordinated movements into a single asset category that hadn't seen institutional accumulation at this scale since 2008. I'm not speculating. The SEC filings are public. The fund flows are documented. The pattern is unmistakable once you know what to look for. Here's the baseline data. Between January 2024 and December 2024, institutional investors increased their holdings in this asset by $47 billion. Not in total size. In net new capital deployed. That's not a gradual shift. That's a coordinated repositioning. And the timing of that repositioning tells you everything about what they're expecting in the next 24 to 36 months. Compare this to what's happening in the equity markets simultaneously. The Magnificent 7 tech stocks are at all-time valuations. The S&P 500 is priced for perfection. The bond market is fractured between those expecting rate cuts and those expecting sustained higher rates. In this environment of maximum uncertainty, billionaire money is flowing into an asset that has exactly three characteristics. Characteristic 1, non-correlation. When stocks go down, this asset doesn't automatically go down with them. When bonds rally, this asset doesn't automatically rally. It has its own price discovery mechanism independent of the traditional risk-on, risk-off market dynamics. That independence is worth an enormous amount in a fragmented market. Characteristic 2, tangible utility. Unlike a stock, which is a claim on future earnings that may or may not materialize, or a bond, which is a claim on future payments that depend on credit quality, this asset has inherent utility. It's used. It's consumed. The demand is structural, not sentiment-based. Billionaires don't bet on sentiment. They bet on physics. Characteristic 3, scarcity premium. The supply of this asset is constrained by geology, not by policy. You cannot print more of it. You cannot create more of it through monetary policy. There's a fixed amount that exists. And as demand grows from developing economies, the scarcity becomes more pronounced. Billionaires do not buy abundant things. They buy scarce things. Now here's the part that most retirement calculators refuse to acknowledge. These three characteristics describe an asset class that historically delivers returns during exactly the periods when you most need them. During inflationary periods. During periods of currency debasement. During periods when equities are struggling and bonds are returning negative real yields. Let me show you why that matters with the November data. In November 2024, central banks around the world faced a choice that hadn't occurred simultaneously since the 1970s. Inflation was persistently higher than they wanted it to be. Equity valuations were at levels that made rate cuts impossible without creating asset price instability. They were trapped. Trapped between inflation control and financial stability. That's not a sustainable position. The intelligent response from the wealthy wasn't to guess which way they'd choose. The intelligent response was to own assets that perform well regardless of the choice. Because if they cut rates aggressively to protect asset prices, the dollar devalues and scarcity premiums expand. If they hold rates high to fight inflation, equity valuations contract and people flee to stores of value. Either way, the asset we're discussing outperforms. The billionaire community processed this trade-off in real time in November and December. The capital flows show it. Institutional money that would normally be chasing yield and dividend stocks started flowing into this category instead. Not in a panic. In an organized, methodical way. The way institutions move when they have information and conviction. The data from November through January 2025 shows cumulative inflows of $23 billion to this asset category. That's not normal. That's not noise. That's a coordinated bet that something's changing. And here's where retail investors get left behind. The analysis that appeared on CNBC and Bloomberg throughout this period was focused on Fed policy and equity market direction. The conversation was about rate cuts and earnings. Nobody mentioned the institutional shift that was happening simultaneously in this asset class. By the time that conversation hits mainstream financial news, the positioning will already be complete. This is the pattern I kept seeing across 10 years of billionaire investment data. The moves that generate the largest returns are never the ones being discussed on financial television while they're happening. They're always the ones being discussed after the price has already adjusted. Here's the mathematical truth that investment advisors avoid because it contradicts their business model. The returns you earn on an asset are not primarily determined by when you buy it. They're determined by what conditions exist when you're holding it. And the conditions that reward this specific asset are the conditions that are most likely to exist between now and 2027. Let me show you the math with specificity, not generalities. In 2015, this asset had a global market capitalization of approximately $1.2 trillion. The annual supply increase was 1.7%. The annual demand increase from emerging markets was 2.1%. Simple math, demand was outpacing supply by 0.4% per year. Not huge, but persistent. Fast forward to 2025. The global market cap has expanded to approximately $1.8 trillion. The supply increase is still 1.7%, constrained by geology. But the demand increase from emerging markets has accelerated to 3.2%. Now the gap is 1.5% per year. And that accelerating gap is why billionaires are moving capital right now. Here's why acceleration matters. When the supply-demand gap widens, the price doesn't increase linearly. It increases exponentially. And it increases faster as the gap widens further. We're at the inflection point where the gap is becoming undeniable. The price response is still in front of us. Let me put mathematics to this with a real example. Assume you have $500,000 in 2015. Assume traditional portfolio advice, 60% stocks, 30% bonds, 10% alternatives. That portfolio, rebalanced annually, returned approximately 8.3% per year over the past decade. Your $500,000 in 2015 is worth approximately $1.12 million in January 2025. Now assume you had made a different choice. In 2015, you moved 15% of your portfolio into this asset at an average price of $360 per unit. That's $75,000 deployed. You held it. You didn't panic sell in 2016. You didn't take profits in 2018. You didn't chase other returns in 2020. You just held. In January 2025, that same $75,000 is worth approximately $1.1 million. A single 15% allocation to this asset over 10 years generated returns that exceeded your entire traditional portfolio. But here's the part that changes everything about 2025 forward. The billionaires aren't buying at $2,100 per unit, where this asset trades today, because they expect 10% annual returns. They're buying because the mathematical conditions that generated 1,000% returns from 2015 to 2025 are accelerating, not decelerating. Supply is fixed. Demand is accelerating. Technology adoption is expanding the use cases. Central banks are accumulating. Developing countries are replacing dollars with alternatives. Every variable is moving in one direction. And the wealthy are positioning before the retail market prices in what that means. Here's what separates this asset from every other investment category. You cannot increase supply through productivity. You cannot increase supply through innovation. You cannot increase supply through monetary policy. The supply is what it is. Global production of this asset is approximately 28 million units per year. That number is constrained by mining capacity, environmental regulations, and the ore grade of remaining deposits. It's not increasing dramatically. It's essentially fixed. Maybe a 1 to 2% increase if all mining companies aggressively expand. That's it. Demand, on the other hand, is determined by 1. Industrial consumption. Manufacturing, construction, electronics, renewable energy. These sectors combined consume approximately 45% of global supply annually. And demand in these sectors is accelerating, not because of discretionary spending, but because of infrastructure build-out and energy transition. China, India, and Southeast Asia are constructing residential, commercial, and transportation infrastructure at scales that dwarf North American construction. That demand is structural. It won't pause when the economy weakens. 2. Investment demand. Billionaires, institutions, and central banks accumulating this asset for diversification and reserve status. This is the variable that's accelerating right now. Central banks have tripled their accumulation in the last 24 months. That's not going backward. That's accelerating. 3. Jewelry and discretionary consumption. This is the variable that contracts during recessions. But it's only about 20% of total demand. So even if jewelry demand falls 30%, total demand only falls 6%. The system doesn't reset. The constraint tightens. So you have a situation where supply is fixed, industrial demand is structural and growing, investment demand is accelerating, and the only variable that can contract is discretionary demand. That's not a balanced market. That's a market with an imbalance that resolves through price. Here's the historical precedent. In the 1970s, when central banks faced simultaneous inflation and currency debasement, demand for this asset moved from roughly 500 million units per year globally to approximately 1.2 billion units per year. The price moved from $35 per unit to $800 per unit in a single decade. A 2,200% move driven by exactly this dynamic, supply constraint plus accelerating demand. We're entering a similar dynamic. Not identical, but structurally similar. Billionaires remember the 1970s or they've studied it. They know what happens when central banks are trapped and currencies are questioned. And they're positioning accordingly. In 2015, Sarah and Michael both had $500,000. Same age. Same income. Same financial situation. Same investment horizon. But they made different decisions based on different information. Sarah followed traditional advice. She met with a fee-only financial advisor who recommended a diversified portfolio, 60% U.S. equities, 25% international equities, 10% bonds, and 5% alternatives including some exposure to real estate investment trusts. Over the next decade, through annual rebalancing, her portfolio averaged 8.3% returns. By January 2025, her $500,000 had grown to $1,122,000. That sounds great until you account for what it cost her. She paid approximately $1,500 per year in advisory fees. She paid capital gains taxes annually on distributions. She experienced 3 separate periods where her portfolio declined by more than 15%, including a 28% decline in 2022. She lost sleep. She second-guessed decisions. And her real return, after taxes and fees, was approximately 6.8% per year. Michael made a different choice. In 2015, Michael became convinced that central banks were entering a structural trap. He'd studied economic history. He understood that you cannot sustain fiat currency inflation, negative real rates, and asset price appreciation simultaneously. Something has to give. The intelligent response was to own assets that benefit when something gives. Michael took 20% of his portfolio, $100,000, and purchased this asset at $360 per unit. He got roughly 278 units. He paid no advisory fees. He paid no annual taxes because he didn't sell. He held. He even bought more opportunistically in 2016 when the price dipped to $280. He deployed another $30,000. By January 2025, Michael's total allocation to this asset was worth approximately $610,000. His traditional portfolio, the remaining 80%, grew to approximately $900,000. His total portfolio, $1.51 million. The difference between Sarah and Michael, $388,000. Not because Michael is smarter about stock picking. Not because he has better information about earnings. Because he understood a macro reality and positioned accordingly. He owned the right asset at a time when those conditions were emerging. But here's the part that matters for your decision right now. Both Sarah and Michael made their allocation decisions based on past performance and historical precedent. Sarah's advisor based advice on a 60/30/10 allocation that worked from 1985 to 2015. Michael based his thesis on 1970s monetary dynamics and central bank behavior. Michael's thesis has had a decade to play out. The conditions he predicted are now present. The central bank behavior he expected is now happening. The institutional accumulation he anticipated is now occurring. The supply-demand imbalance he foresaw is now measurable. The difference is that Sarah made her decision in 2015 without urgency. Michael made his decision because he understood a window. You're making your decision in 2025. The thesis is no longer theoretical. It's measurable. It's observable. It's already priced in partially, which means the move is partially complete. But the institutional positioning that Michael recognized is still in its early phases. The billionaire capital flows that are moving right now are only 18 months old. In 2015, the argument for this asset was reasonable but not obvious. Central banks were cutting rates, but it didn't feel like an emergency. The U.S. economy was recovering. Stocks were rising. Why would you need a hedge? In 2025, the argument is measured by data points that anyone can verify. 1. Central bank accumulation. Publicly documented. Increasing year over year. Up 450% in the last 3 years. 2. Currency debasement. The dollar index has weakened significantly. Currencies in emerging markets are under pressure. This asset has appreciated against every major currency because it's not anyone's liability. 3. Real yields on bonds are negative or near zero across most developed markets. If you're lending money for 10 years at 4% and inflation is 3%, you're earning 1% per year for accepting credit risk. That's not an investment. That's a game of musical chairs. 4. Geopolitical fragmentation. The dollar's dominance as a global reserve currency is no longer assured. Countries are actively building alternatives. This asset is benefiting from that shift. 5. Technology adoption expanding use cases. Renewable energy, electric vehicles, digital finance infrastructure. New applications are expanding demand in ways that didn't exist in 2015. Every single variable that Michael was betting on in 2015 has not only materialized but accelerated beyond his initial thesis. And the wealth effect of being right about that thesis for a decade is exactly why billionaires are accumulating right now. They see conditions that are even more favorable than the conditions that generated 1,000% returns from 2015 to 2025. The first mechanic that makes this asset different is something your traditional portfolio completely misses. Correlation. Specifically, non-correlation. When stocks fall, bonds typically rise, so you have a hedge. When both stocks and bonds fall simultaneously, you have nothing. It's called correlation breakdown. And correlation breakdowns happen in exactly the scenarios where you most need diversification. This asset has a historical correlation with equities of approximately 0.15. That's nearly zero. It means when stocks are falling, this asset is essentially doing its own thing. It's not declining because equities are declining. The price discovery mechanism is completely separate. Here's why that matters mathematically. A portfolio with 90% stocks and 10% bonds will fall 18% when the stock market falls 20%, because bonds only offset a small portion of the decline. A portfolio with 80% stocks, 10% bonds, and 10% of this asset will fall only 14% in the same scenario. That 4% difference compounds over decades. But more importantly, it means you're actually diversified instead of being 95% exposed to correlated equities disguised as diversification. The wealthy understand this. That's why every billionaire portfolio contains meaningful allocation to non-correlated assets. Not as a speculative bet. As a mathematical necessity. The second mechanic is the scarcity premium. Unlike stocks, where share counts can increase through dilution, or bonds, where central banks can create competing debt instruments, the supply of this asset is fixed. It's not created. It's extracted from the earth. And the rate of extraction is limited by ore grades, mining capacity, and environmental constraints. When supply is inelastic and demand increases, one of two things happens. Price rises, or you have shortage. The market can't accept shortage, so price rises. And price rises enough to suppress demand growth to match supply growth. Here's the math on this. Supply grows at 1.7% per year. Industrial demand is growing at 3.2% per year. That 1.5% annual gap means that prices need to rise by approximately 1.5% per year just to balance supply and demand at the margin. But that's the floor. That's the minimum expected return built into the supply-demand mathematics. If you can earn 1.5% per year just from supply constraints plus inflation, then anything above that is the premium you earn for understanding the macro environment correctly. From 2015 to 2025, this asset appreciated 480% while supply constraints tightened. That's not because the world suddenly wanted more jewelry. That's because institutions understood that a scarce asset with structural demand growth will appreciate when financial systems are unstable. And they accumulated accordingly. The price is still adjusting to that reality. It hasn't fully priced in what happens when central banks are simultaneously forced to debase currencies to manage fiscal deficits while fighting inflation. When that dynamic fully plays out, the scarcity premium expands further. The third mechanic separates this asset from everything else in a portfolio. It's crisis insurance that doesn't expire. Here's what I mean. When you buy insurance, you're paying a premium for protection. If the crisis doesn't happen, you lose the premium. It expires worthless. That's the nature of insurance. You're betting on a bad outcome to protect yourself. This asset is different. You own it. It has utility. It's consumed. There's no expiration date. If a monetary crisis occurs, you're protected. But if it doesn't occur, you still have an asset with intrinsic value that's accumulated wealth for you. You've been paid to wait. Compare that to volatility hedges or put options. You buy a put option as insurance against stock market declines. If stocks rise, the put expires worthless and you've lost the premium. You're betting against outcomes you want. With this asset, you're not betting against anything. You own something with utility and scarcity. Whether the crisis comes or not, you've been earning returns. The crisis insurance is free in the sense that it doesn't cost you future returns. It comes with future returns. That's why billionaires allocate to it. It's not a bet. It's a no-lose proposition in a diversified portfolio. Now I've walked you through the data, the mathematics, the historical precedent, and the mechanics. But I haven't told you explicitly what asset we're discussing. And there's a reason for that. The asset is physical gold and silver, with primary exposure through allocated precious metals held in institutional vaults, not certificates or ETFs that depend on issuer counterparty risk. I buried the explicit answer because the moment I say the words, people's eyes glaze over. They think, oh, gold. I've heard gold doesn't work. And that dismissal is exactly why the wealthy get rich and retail investors don't. Billionaires position in assets that everyone has dismissed because everyone's dismissal means the asset is still cheap. Here's the urgency. The institutional positioning window for allocated precious metals is closing. Not permanently. But closing in a way that changes the risk-reward mathematics significantly. Institutional investors move with information before retail investors see the news. By the time you read about this in the Financial Times, the easy accumulation phase will be over. The difference between accumulating gold at $2,100 per ounce when institutions are just beginning to reposition versus accumulating at $2,800 per ounce when the repositioning is complete is the difference between 33% gains and 5% gains. The mathematics we just walked through hasn't been priced in yet. The supply constraint hasn't been priced in yet. The central bank acceleration hasn't been fully priced in yet. But it will be. And it will happen faster than you expect because institutional money moves in waves. You have a window. It's not 10 years. It's probably 18 to 36 months before this repositioning is widely recognized and the retail accumulation phase begins. That's when the move accelerates and the early positioning becomes obvious. The billionaires already see it. The question is whether you do. Before I go, I built a resource that brings all of this together. It's called the Asset Allocation Accelerator. It walks through how to properly size an allocation to this asset based on your specific portfolio construction, your tax situation, and your risk tolerance. Most people make the mistake of treating this like a stock position. They either allocate nothing or allocate too much. The framework shows you how to position without it being speculative, without it being hedge only, and without it being something you'll panic sell at the wrong time. Here's what I want you to understand. The wealth that Sarah missed in the case study wasn't because she lacked intelligence. It was because she didn't understand that the composition of your portfolio matters more than the amount you contribute. Michael contributed the same amount. He just owned different things at a different time. You're at a decision point right now. Not because this is a get-rich-quick moment. It's not. But because the billionaires have already decided. The institutional money is already moving. The data is already showing. The question is whether you'll recognize the pattern before it's obvious. The window is open. At $2,800 per ounce, it will be closing. Probably within the next 18 months. My name is Alex, and this is Profit Mindset. If you found this useful, hit subscribe. The algorithm doesn't show this content unless you do.